Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Participants are often cautious going into a data heavy day like yesterday. It's primarily because data coming higher or lower than expectations can force markets to reprice their future expected direction of the monetary policy, growth, inflation, or company specific earnings. In this light, yesterday we had some important data from US, eurozone, and India. Morning, JK. Take our listeners through the host of data out yesterday. Are we observing any change in the rate cut expectations now?
Good morning, Swaraj. No, there is no major change in the rate cut expectations. But all said, yesterday's data, actually was relief for the markets that, it did not spring a nasty surprise. And most of in fact, all the numbers came as expected as far as the US PCE numbers were concerned. And we saw a relief rally in the markets, both in the bonds as well as in the stocks. Relief that the January core PCE was not higher than feared. And more reasons to rally was given by the jobless claims data that showed labor market not as tight as the previous data had shown. The yields fell about 3 basis points in the long end, and twos were little lower, not much movement. Expectations on the rate cuts remain unchanged, around 62% probability for the June meeting as well. Yeah, but the PCE number itself shows that 0.42 month-on-month increase was the largest in the core PCE for a year, though expected, coming off a very tight Q4. Moreover, the breakdown does not inspire much optimism, with the services index up 0.6%, the largest jump since 2022. But the prices were down for the goods. That's why it still stayed at 0.4%. The Fed has at times paid attention to the measure of service inflation for the evidence that the price pressures are slowing down in a broad gauge. And so that's why the status quo on the rate cut probabilities. Most of the Fed member statements post the data also continue to hint at wanting to see more numbers before concluding that the inflation is moving towards their target of 2%, and hence encouraging a wait for moving lower in rates. And also we had the data from Europe, where we had the inflation number from major countries, that is France, Germany, and Spain. All of them have shown, kind of weakening inflation pressures. As you can see, the inflation eased in France, Spain, and Germany, which are the largest states. Uh, you know, this means that the eurozone inflation, which will be published today, will also come lower at 2.5% from the 2.8% in January, which means it is moving closer to ECB's own 2% target. In France, the harmonized inflation dropped to 3.1 from 3.4, while in Spain it slowed to 2.9 from 3.5. In Germany, most of the large states within the country saw big dips in the inflation, suggesting that a fall to 2.7% from 3.1%, as expected by the economists, was quite realistic. Overall, the numbers show that the disinflation process continues in eurozone, compared to US. In fact, in Germany, the labor market slack in Germany also increased a touch, potentially pointing to some easing wage pressures, as per the data that was seen. Now, if you look at the currencies, in a race to which central bank will cut rates first, Europe seems to be winning it at the moment, because they have a tepid growth picture and lower inflationary pressures compared to the US. So ECB may act sooner than later. The single currency has been well supported by some improving economic data, and more recently, the month-end demand, however, 1.0850 proved too strong to break, and we see it easing towards 1.07 again in the coming days, possibly attempting to break that if ECB turns more dovish, which I expect. Now, in Japan, somewhat stronger indications from Japanese official yesterday that they are much closer to ending negative interest rate policy was enough to push the dollar yen lower. That apart, there have been voices again expressing concern on one-way move in the yen, and 151 to 152 level is a very touchy level, as we have been sharing a lot many times. So that is something that we need to watch out in Japan, what kind of action that will be coming through. Overall, the dollar index itself has been still moving in a very narrow range of less than 1%, with technicals giving a slightly supportive picture for the dollar. We do not see a decisive movement in the dollar near term, with a lot of uncertainty about monetary policy once again. As far as the stocks are concerned, we had the Nasdaq hitting a new high yesterday, following S&P and the Dow that hit new highs, in the last week. This was because the inflation numbers did not contain any hawkish surprise. European inflation also giving some comfort to the stock market, of course. And Nasdaq actually registered a record closing high for the first time in more than 2 years. And in fact, it has been a very good month for US stocks in February. S&P 500 gaining 5.17%, Nasdaq 6.12%, and Dow climbing 2.22%. Now, even Japanese market today, with the easing, or rather the inflation number not throwing up any negative surprise, and fresh weakness in the yen above 150, ignoring yesterday's statement from the BOJ official, all helped the Nikkei also to touch another new all-time high today. That means, overall asset markets are still quite comfortable, even though the central banks have not been very eager to get into an early rate cut. As far as India is concerned, we had the economic data in the form of GDP for Q4 of calendar year 24, and that was a big number at 8.4%. Now, multiple economists had suggested there will be a moderation in the GDP number due to decline in government spending, slow growth of industrial output, and an uneven monsoon in the third quarter. However, on the back of a good performance in sectors such as construction, mining, and quarrying, as well as manufacturing, the economic growth actually witnessed a significant upswing. Details show that private consumption rose at a much faster rate of 3.5% versus 2.4% in Q3, and the investment growth remained robust, although it slowed from 11.6% to 10.6%. Both exports and imports rose at a slower pace. Public expenditure contracted at 3.2%. Now, interestingly, Q3 data on India's growth threw up a divergent trend, with the GVA growth actually moderating broadly on expected lines to 6.5%. Now, what's the difference? Because the GDP includes the taxation on the actual producer value, plus any minus any subsidies that they give. Therefore, GDP number will always be higher than the GVA number, and this wide gap followed from a surge in the growth of net indirect taxes to a 6-quarter high of 32% in Q3 of FY24, and that is unlikely to be sustainable. Therefore, in our view, it is better to look at the GVA growth to understand the underlying momentum of economic activity. GDP might actually give a lopsided view. So that's a mixed picture as far as Indian data is concerned. But one cannot deny the fact that Indian growth, even at 6.5% of GVA also, is a very strong number and a consistent strong growth. So the strong growth of the economy, along with the inflation remaining contained near about 5%, does not give any room for a change in monetary policy for the near term. Now, the rupee has so far not given an indication of breaking out of its narrow range. We believe, however, that the seasonality and the enhanced flows for bonds will help currency to appreciate in the coming weeks towards 80 to 70 and perhaps 80 to 50 as well by the end of March, which is the financial year end. We also think that the improved fiscal external balances, consistently robust growth of the economy merits a rating upgrade that can invite more investments and possible some appreciation on the rupee as well. Thank you.
Thank you, JK. And just quickly summarizing, Yesterday's data was a relief for the markets as there was no big surprise. And when it comes to the inflation of other major countries in the eurozone, seen some signs of easing in price pressures. Eurozone inflation will be published today, and it is expected to move lower based on the data published by Germany, France, and Spain yesterday. And this is, of course, moving close to the ECB's target inflation rate. And when it comes to which central bank will cut rates first, EU seems to be winning that race. Uh, Tepid growth as well as inflation moderating should help the ECB cut rates first. When it comes to India, we had the economic data Q4 GDP. There was a big number at 8.4%. It has it has shocked some economists, but to get the entire picture, we also have to look at the GVA number which was published. So that's what JK had mentioned. And as of now, for rupee, there is no indication of a breakout, but the strong macro fundamentals as well as the flow should help the pair to appreciate towards 80 to 70. That's it from us today. Thanks for listening. Have a very good weekend and tune in on Monday for the latest in the financial market.